In today's episode, we're talking about two different reasons why the stock market could be going up at the end of this month. At the very end, I'll go over my stock portfolio just like we do every single week and tell you which stocks I bought this past week. We'll also go over the stocks that I'm buying next week as well, so you won't want to miss that. But before getting into all of that, this episode is sponsored by Cantech Letter. Cantech Letter is a site that I love to use for stock market research because they have articles written based on analyst opinions. They focus primarily on Canadian companies and cover small cap stocks as well, like Well Health Technologies, D2L, Kinaxis, Lightspeed, and other small cap Canadian stocks. So be sure to check out the website and sign up for the newsletter if you want to keep up to date, and this is all completely free. Now, all that being said, the first reason why we could see a rally going into 2022 is the Santa Claus rally phenomenon. If you guys are not aware of the Santa Claus rally phenomenon, then let me explain that to you. So the Santa Claus rally usually occurs at the very end of the year when Christmas time is happening. And the reason why this rally happens is because Wall Street tends to go on vacation. And retail investors, they're kind of, off at home, and why not trade some stocks? Retail investors tend to be a bit more optimistic than our Wall Street friends. And very few retail investors engage in shorting activity. So when most of the market is just retail investors, stocks tend to go up because retail investors are buying for the long term. On top of that, a lot of retail investors who are just average workers out there, they've also got their year-end bonus to invest. So with this extra influx of money, this is another contributor of the Santa Claus rally. On top of that, the institutional investors have finished their tax loss harvesting before going on vacation. So all that selling that you might see at the beginning of December before people go on vacation, that tax loss harvesting tends to cease around Christmas time. There is no guarantee that we're going to see a rally at the end of December. However, if we look historically, this is what tends to happen. So this is the first reason we could see a rally at the end of this year. The second reason comes from an article that I read where they interviewed Marko Kalanovic, who's a quant trader, and he predicts that the short sellers in the market are going to get squeezed at the end of this year. On top of that, he says the outlook for Omicron isn't as bleak as people seem to make it out to be, because Omicron is not as deadly as Delta, and there's less hospitalizations. So people who are freaking out about this new variant, I think that it's overdone. I think that we've seen a lot of selling action, there's a lot of cash on the sideline, and this quant trader also agrees and thinks that people will eventually put their money back into the market because we still haven't seen interest rates rise just yet. Yes, they might happen next year. However, interest rates are still at fairly low levels, even after 3 rate hikes that might come next year. And we've also seen the markets defy COVID because the markets have shot to new all-time highs. We've never been at this high in the stock market in history before. And this is happening even during a global pandemic, even during all these shortages. And honestly, no one would have predicted this. Now, when we look back 2020, a lot of people attribute this because governments are printing money left, right, and center. So when you print money out of nothing, everything else can't just stay the same value. It has to go up in value just because you can't make value out of nothing. The market knows that there's more currency in circulation, and therefore it's going to be like, that's not fair that you're printing money. So we're going to have to raise prices for you doing that. And that's essentially what inflation does. And you could say that stock prices also receive the same sort of inflation. I mean, their inflation was a lot higher than other costs of goods. Like some stocks have shot up by 100%. So for this reason, I think it's very possible that the stock market could go back up and sustain the same levels that we had a couple months ago. The Fed tapering their buying of bonds has not yet stopped yet, so we're adding even more money into circulation every single day. Technically, we should see inflation happen across the board. I know I just got sidetracked a little bit, but let's bring it back to the main points and summarize what we spoke about already. The first reason the market could go up is because of the Santa Claus rally. And the second reason, which is kind of twofold, is the fact that we just had a steep sell-off, and I think that the sell-off could have been due to shorts, and those shorts could get squeezed soon. And the fact that Omicron isn't as bad as Delta, there's less hospitalizations, and therefore the stock market sell-off because of Omicron is unwarranted. Now, as for what I'm doing, I'm always looking for good deals out there in the market. And a lot of growth stocks got hit very heavily. Some of these stocks are down 60, 70, 80, or even 90% from their all-time highs, and the business has not even changed. It's just investor sentiment. So for me, I'm going to be looking prudently at the positions I have, the ones especially that are down, and choosing which ones I want to dollar cost average into. As usual with my TFSA portfolio, like you're going to see later on, I'm depositing $200 every single week and will be investing that $200. For my other portfolios, I'm a bit more selective of when I'm buying into the market. So recently I haven't been buying in that much just because everything's been a falling knife. But if we see some sort of consolidation, then that's where I'll be buying in. And I think right now is a good time to start nibbling in before the short squeezes and the Santa Claus rally. Now let's jump over to my portfolio on my computer and we'll talk about the stocks that I bought this past week and what I'm buying next week. This is the 40th week of my TFSA portfolio, and right now, looking at the portfolio, we're back down in the red by 1.2%. In dollar amounts, I'm down $118.22. So it's unfortunate that this has happened. However, that's just the way that investing works. If you're a long-term investor, you're going to see ups and downs in your portfolio. But I think one of the most important things is to stay steadfast in your investing methodology. So for this portfolio particularly, I'm doing dollar cost averaging, and every single week I'm still putting in $200 whether or not my portfolio is up or down. The total market value is still just shy of $10,000, and I haven't been able to crack that, but I have no doubt eventually this portfolio will go past $10,000. It's sitting at $9,773 and change. Now, if we jump over the transactions, we can see all the different stocks that I bought this past week. So on the 13th, I bought some Shopify, I bought some D2L. On the 14th, I bought some more Shopify. And you can see that Shopify stock price has been dropping. And whenever it's around $1,700 or $1,600, that's when I'm buying $25 of this stock. And I honestly love Shopify for the long term. Although everyone says it's wildly overvalued, I'll continue to dollar cost average into this position. You can see that I'm putting in $25, which is a very small amount, every single week, and later on you'll see my Shopify position is not even anywhere close to number one in this portfolio yet. So I'm taking my time slowly and building up this position because I honestly don't know if this stock is going to be up or down in the next 2 or 3 weeks. So why put all my eggs into one basket and buy in large chunks when I can space it out over time? That's just one way that I do risk management right now. Now, if you're a day trader and you think that $1,700 is super cheap and you know some insider information or can read charts and think that the stock will go to $2,000 in a couple weeks, then by all means put in hundreds of thousands of dollars if that's your investing style. Now moving on the 16th, I bought 3 more positions. I bought Well Health, D2L again, and Air Canada. Now I think that we're getting a pretty good bargain with Well Health, seeing that it's held the $7 mark quite steadily over the past year. Obviously right now small caps are getting hammered, and it's possibly because of some short selling out there or people just cashing out of the market, not as much interest anymore. And Well Health, they are cash flow positive based on their operations. So this company doesn't necessarily need to raise any more cash to continue their operations and continue to live as a company. But if they do so, it's more to accelerate the growth of their acquisitions. And what's interesting to me is that as small caps go down, I think that acquisitions for non-public companies that are smaller, the prices for those companies are also coming down. So Well Health is able to deploy their cash and buy up these companies for a little cheaper than what they were getting them for just a couple months ago. Air Canada is a reopening play, and right now we're in the middle of, I guess, another wave of the pandemic with Omicron. However, I think with this virus, which I talked about earlier, it's not as strong as Delta, and not many people are getting hospitalized compared to Delta. I think that this is a good sign, and eventually these recovery stocks will recover. Right now, I'm just dollar cost averaging, not super heavily, but just like Shopify, buying 1 share at a time each week. Now, going over the entire portfolio over the past week, we can see that D2L is the biggest loser. And I think right now, as I mentioned in other episodes, D2L just doesn't have as much public awareness. So people don't really know what this company is, and those who know what the company is, it's probably those who just graduated from university and don't have much money. And that's because D2L provides software primarily for universities. Now, eventually, I think those people who are young and use D2L's product, they might end up coming up with some cash after they pay off their student debt. And when they start looking at investing, maybe D2L's name will be one that they search up. So we'll have to see where it goes in the future. But right now, as I stated in my first D2L analysis video, I think that D2L still is cheap compared to its competitors. And I'll continue to buy the stock as long as it's trading, below its IPO price. Enghouse is a stock that's actually fallen quite a bit this past week, 10%. And Enghouse is similar to Well Health Technologies, where they buy up a lot of companies. But I think for Enghouse right now, their issue is the fact that they were trying to buy up companies when the whole market was expensive. But now that we see the market coming down and even Enghouse stock coming down, I think we could see other other companies that they're looking to acquire become a lot cheaper than they were before. This is their specialty essentially, where they can pick up other companies that are still private or even public companies and buy them out for a lot cheaper. And they only do this if this makes business sense. What they're looking for is cash flow positive businesses that have a very strong product. And Enghouse has had a history of determining what those companies look like. Now, sorting this portfolio by market cap, just taking a look at which stocks I want to bolster my position in. I know that previously I mentioned I was going to buy Nuvei in this portfolio, but I hadn't yet taken the plunge last week. Potentially this week with more of a sell-off, I think I might start my position, but you'll have to stay tuned till next week. And subscribe if you don't want to miss that video. So I think other stocks that I'm going to plan to buy next week, D12 is another one, just because right now it's still relatively low or a small position in my portfolio, sitting at $271 compared to my largest position at almost $1,000. I'm going to also continue to increase my Well Health position slowly at $460 right now. Kinaxis is another stock that I might start dipping my toes into again, just because the price has come down from around 210 to 170. And companies have obviously realized supply chains are a very important part of the business, just with all the shortages this past year. That Kinaxis has a fairly steady business model, and I think customers realize the value of their product. Shopify again is also looking juicy because you can see it's not very high on this portfolio right now in terms of position size. So be sure that I'll be buying some more Shopify this week as well. Thanks for stopping by and watching this video. If you got a lot of value, remember to leave a like down below. If you want to follow along my journey of this TFSA portfolio, be sure to subscribe to my channel. As well as I've got a couple videos on the screen right up here. If you're there, I'll see you there. If not, keep up the grind and have a great day.